Hello savvy investors and welcome back to the channel. Today, we're diving deep into the fascinating world of hard-to-borrow stocks and what it could mean for your trading strategy. We screen thousands of equities every day looking for those unique situations that catch our eye, and one name has popped up with some truly remarkable characteristics: ATP Corporation, or ATPC. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what exactly is ATPC? ATP Corporation is an investment holding company based in Malaysia. They operate in the consumer defensive sector, specifically within packaged foods, though their business also spans health and wellness products and advisory services, with segments in skincare, health and wellness, and green energy. It's a micro-cap stock with a market capitalization of just $2.04 million, which puts it in a very specific, often volatile category. Let's look at the recent price action. Today, ATPC saw a change of minus 5.79%. Over the last 5 days, it's been up plus 3.83%, but looking at the last 30 days, it's down minus 22.54%. Joe chart, ATPC 30-day price volume-wise, today saw only 72,549 shares traded, which is a stark contrast to its 30-day average volume of 1,738,804 shares. That means its relative volume today is essentially Xerox's average, indicating extremely low trading activity. What is cost to borrow and why it matters? Now let's talk about the bedrock of our analysis, the cost to borrow, or CTB fee. For those new to this, when you short a stock, you borrow shares from a broker and sell them, hoping to buy them back later at a low price. But borrowing those shares isn't free. You pay a fee, much like renting a car you plan to sell and repurchase. This fee is the cost to borrow, typically expressed as an annualized percentage. Show graphic, CTB. Explain why does it matter? Because a high CTB directly increases the pressure on short sellers. The longer they stay short, the more they pay, eating into their potential profits, or worse, accelerating their losses. Yes, these fees can exceed 100% annually, sometimes significantly, if the demand to short a stock is incredibly high, or the supply of shares available to borrow is incredibly low. Why this stock is hard to borrow right now. This brings us to why ATPC popped up on our screener. Its annualized cost to borrow fee is an astounding 742.5%. Highlight 742.5% on screen. That's right, 742.5%. To put that in perspective, that's not just high, it's astronomical, indicating immense demand to short the stock or an extreme scarcity of shares available to borrow. We estimate ATPC's float, that's the number of shares readily available for trading, to be only around 0.5 million shares. That's a tiny float, making the available shares even more precious. While the exact number of shares currently available to borrow is unknown, this combination of a very small float and an exorbitant CTB fee tells us that finding shares to short ATPC is exceptionally difficult and expensive. Our composite squeeze score for ATPC currently stands at 50.5 out of 100, indicating a moderate but certainly not extreme potential for a squeeze based on our criteria. Squeeze mechanics explained. So, what's a short squeeze? Imagine all those short sellers paying the 742.5% CTB fee for ATPC. If the price starts to move up, or if that CTB fee continues to climb, these short sellers face a tough choice. They are squeezed. To limit their losses or stop paying those hefty fees, they have to buy back the shares they borrowed and sold. This buying action creates demand, which can push the price even higher, forcing even more short sellers to cover, creating a cascading effect. It's a feedback loop where short covering fuels further price increases, leading to more covering. The shrinking supply of borrowable shares, combined with high CTB, can make it nearly impossible for new shorts to enter and existing shorts to manage their positions without incurring significant costs or losses. Dilution risk check. An important aspect to check when looking at potential short squeeze plays is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This typically lowers the price per share and can provide an out for short sellers, as new shares become available for them to buy back and cover their positions, effectively negating or significantly dampening a squeeze thesis, even if the cost to borrow is sky high. For ATPC, we found no recent dilutive SEC filings such as -1s, -3s, or 424 BS in the last 90 days. We also found no recent reverse splits in our look-back window. This is a positive sign, as it suggests that, for now, the company isn't actively working to increase its share count in a way that would immediately alleviate pressure on short sellers. Again, please remember this. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Now, it's crucial to understand that a high cost to borrow, even one as eye-popping as 742.5% for APC, does not guarantee a short squeeze. It can also simply indicate that short sellers have an incredibly strong conviction in their bearish thesis and are willing to pay a premium to stay short. For APC, with its tiny 0.5 million share float and that extreme CTB, here's what we'd be watching. First, continued high or increasing cost to borrow. Second, a decrease in the available shares to borrow, although this data is currently unknown for APC. Third, a significant increase in trading volume. Remember, APC's relative volume today was 0x its average. For a squeeze to ignite, you typically need to see sustained buying pressure that pushes prices up and forces shorts to cover. Without increased volume, even with high CTB, a squeeze is difficult to spark. And finally, a shift in price momentum to the upside. Our composite score of 50.5 reflects these factors: high CTB, small float, but currently low volume, and a recent downtrend. ATPC Corporation, or ATPC, presents a truly intriguing case study with its astonishing 742.5% cost to borrow fee and minuscule float. It's a prime example of a stock that is extremely hard and expensive to short. While this doesn't guarantee a squeeze, it certainly puts short sellers under immense financial pressure. Keep an eye on its volume and price action moving forward. We hope this deep dive into APC has helped you better understand the mechanics of hard-to-borrow stocks and potential squeeze situations. If you found this information valuable, please hit that like button, subscribe for more in-depth analysis, and let us know in the comments what other stocks you'd like us to investigate. Thanks for watching, and we'll see you in the next one.